What is going on, traders? Jam-packed show for you today as the S&P 500 and the NASDAQ both hit correction territory. Of course, a correction means a drop of minus 10% or more. We are at the level that I was eyeing since the beginning of September on the S&P 500. So the question on a lot of your minds, where is the market bottom? When is the market bottom? Is the market going to crash further? What does history tell us is going to happen from here? Well, lucky for you, this video is going to be jam-packed with data. I will obviously give you my analysis as well, and then I will tell you towards the end of the video, as I do every single video, and I hope you guys appreciate that. Leave a thumbs up if you do. I'll give you a brief update on how I'm playing the market. So you definitely want to stick around till the end. Check out my plays. But for now, let us get into this. Welcome back to the Traveling Trader. Good to have you guys. So, as I said, the S&P 500 is in correction territory. Now, let's take a look a little bit more before I get into the data, and I will get into the data for you guys because I have some really interesting data points into how long corrections usually last on average. I also have some data points as to whether stocks right now are undervalued or not, whether they are undervalued historically. And then, of course, you guys know, if you have been following this channel, that the Magnificent Seven stocks, which are basically Apple, Nvidia, Google, Amazon, Tesla, Microsoft, and Meta, those 7 stocks have been lifting the stock market all year. What is up with those 7 stocks? Are they currently still, in good shape? Well, if you look at the market, we'll get into that in a second. Let me jump into the charts first, okay? And then we'll get into that. Here we go. So on the chart, you see that the S&P 500, well, let me actually chart the SPY for you. You see that the SPY is actually not yet at a 50% retracement from highs. Now, when we saw the S&P 500 back in October 2022, if we map out the pandemic lows to the all-time highs, you will see that we finally bounced off of the 50% retracement. Now, this is not obviously mandatory, but the 50% retracement is usually a bounce point for institutional algorithms. Now, whether that signals the end of the not bear market, but the end of the correction or not, that the 50% retracement is not really going to tell you that. But what it can tell you, and what I can tell you, is if you only bought stocks and indices, blue chips, right? We're not talking about BS stocks. If you just bought them at 50% retracements, and that's when you made your significant purchases, your gains would be astronomically greater than if you just regularly dollar cost average. Obviously, do what you want. If you guys know how to read a chart, more power to you. However, we have the 50% retracement point. I will be buying. I already started nibbling on the S&P 500 here. We will get into that when I get into my plays. But we are at the bottom of this trend line. Now, why was I eyeing this level? Well, again, if you're fans of this channel, you know that we use the volume profile. I'll draw it for you again. If I take the volume profile and I go from now until back to all-time highs, where was the most volume for the SPY? Where did investors buy the most? At what price? This yellow line right here is called the point of control. You could see that right at this level where we bounced from, around 411, is the most volume that we've ever seen on the SPY going back to January 2022. So this typically, if this level is upheld, then you can have some confidence that we are near the bottom of the correction. Now, if this level is breached, you can see that we don't have much volume support until you get to around the 395 level on the SPY. But we are so far respecting this trend line. Looks like we were going to pop below it. We jumped back above it today as of the time of this recording. It's Monday, October 30th, after market. But this is what I'm looking at currently. Now, this level is going to be very tough to beat, in my opinion, unless the Fed comes through and surprisingly raises rates or does something uncharacteristic. You know, if you have a red folder type of news event that can't be predicted. But this used to be resistance, now it's support. You see that also price was supported here. It's not a surprise that this is where the S&P saw the most volume historically, going back to January 2022. You could see here that between March and May, so 2 whole months, price was stuck here, and then for almost an entire month from January to February 2023, right? So this is a very important level and will likely be a hard level to break, in my opinion. I could be wrong. Obviously, black swans also are something that can't be predicted if they come around this level here. All right, some more data for you, and then we'll get back to the charts. I want you to look at the Magnificent Seven. If you look at the Magnificent Seven here, the reason that I'm looking at this is because, as you know, all of these gains, 100% of these gains were made up by the Magnificent Seven. And if you look at the average stock, the average S&P stock, you'll see that the average stock is actually below the 100-day moving average. This references the NASDAQ, but it also goes the same for the S&P 500, right? Now, there's this thinking that these stocks are actually doing great, but if you take a look at them, they are significantly down from their 52-week highs. You have Apple, is down 15%, Tesla 31% minus, Microsoft minus 10, Alphabet minus 14, Nvidia minus 19, almost minus 20, Amazon minus 12.5, and Meta minus 10.5. So these are all in correction territories, with a couple that are in bear market or near bear market territories, right? So the Magnificent Seven aren't doing that great. Why am I bringing that up? Because most of the Magnificent Seven stocks actually reported decent earnings, right? Some of them don't give guidance, so you're not going to get that benefit. But most of them reported decent earnings. Now, if most stocks are actually really beat up and the Magnificent Seven are all in correction territory, then how much downside is there realistically left? And what would cause, we have to answer these questions, right? And what would cause there to be further downside? If you look at this, this is where the fear and greed index is, right? And we are nearing the areas where we tend to typically see interim bottoms in the market. When the NAAIM and when the fear and greed index are both aligned in the fear category, that's when you tend to see interim market bottoms. Sometimes they are actual market bottoms, like in October, or sometimes they are bottoms where you see ginormous bounces from before a continuation down. So what would actually cause stocks to tank further? Well, one, obviously, if the Fed comes in and decides to raise rates surprisingly, because we have the current expectations that the Fed won't raise rates, 95% that they won't raise rates, not on November 1st and not even on December 13th, right? 75% that they're not going to raise rates, slightly higher that they will raise. Now, also, I posted this on Twitter. Make sure you are following me on Twitter and Instagram for free daily trading and finance content. But I posted this on Twitter and I said, June 29, 2006 was the last rate hike before a recession. It took almost 17 months before we finally hit a recession. And this is very common. You see this every time during rate hiking cycles, that when the Fed pauses, it takes a very long time for recessions to hit. So the Fed is likely going to pause and just keep rates there for a while until something breaks, right? They are basically waiting for unemployment to go up. And it also historically takes a long time for inflation to get back down to 2%. You can see here that now inflation expectations have boomed from 3.5% all the way to 4.2% once again. So it looks like inflation expectations are on the uptick. So I don't think that if the Fed does not raise and if they just hold and are willing to play the long game, then I personally don't think that there is something in the short term, barring a black swan event. I'm not talking about that, but I don't think that there's something besides an event that we can't predict, right? I don't think that there is in terms of normal instances, normal market forces, I don't think that there is really something that would drive the markets down significantly further, in my opinion. One more data point I have for you here. Look at the October-November turn. By the way, this is why one of the reasons why I was bearish, one of the reasons why we took shorts in the SPY is because in October, if you look here, the trailing week since 1975, the S&P 500 has been down 19 times, right? In the trailing week leading up to the October-November turn. And when the S&P 500 has been negative, I want you to take a look at the return on the second day of November. It is insanely green usually. There's only been 2 times. Once in 1975 was negative 0.98. And then there was one time when it was 0, which was in 1983. Every other time it is super green. So we have Apple earnings left on November 2nd. And we have Nvidia earnings on November, what is that, 21st? When are Nvidia earnings? November 21st are Nvidia earnings. By the way, there's going to be, I might as well talk about the plays now, but that is my expectation on the S&P 500. I do think we could see a little more downside. If we do get to that 50% retracement point, I will be a heavy buyer. Also, you guys know the stats that it is very rare to go from a bear market to a bull market back to a bear market the same year. As a matter of fact, it has never, ever happened. So I maintain that I think this is just going to be a correction between 10 and 20%, less than 20%. If we do get to that 50% retracement point, I'll be a pretty heavy buyer here, regardless of what happens for the long-term portfolio. Right. And by the way, now that we are in correction territory, I do think that the market is going to take a little bit longer to recover. So I want you to take a look at something here. This is extremely important. Pullbacks. So when there's a 5 to 9.9%, so less than 10% decline, it takes an average of 1 month to recover for the S&P 500, right? A correction, when we finally hit official correction territory like we are now, it takes an average of 4 months. So to me, that would make sense that we take a little bit longer. Obviously, nobody knows. It could shoot up in a month like we did after the pandemic. Who knows? All right, now here are some of my plays. And by the way, we just published our stats for October. If you want access to all of my plays, all my day trades, swing trades, what I'm investing in, etc., link is in the description below. We have 2 other analysts in the group as well. But here's the October recap. We actually took 22 winners, 4 losers, and 6 break even. Yes, that's right. We only had 32 trades for the month of October. That is quite a bit, actually. That's an average of more than 1 trade a day, which to me is plenty. You don't need to be trading 50 million times a day. The more you expose yourself to risk, the worse it is. But feel free to pause this or whatever, look through it if you want. But that's our stats for October. And click the link below to join us. To join us for less than $100 for life. Make sure that you click the link below. Less than $100 a month for life. We've never released that promo code, and we likely won't do it for a while. So make sure that you click the link in the description. All right, so I do think that there is a chance here. Obviously, we have Apple earnings coming up. I think there's a chance for potentially one more leg down. I have not yet decided. Once you get into this stage of analysis, right, especially when you are dealing in the fringes, it becomes very hard to predict with a huge position. This was one of the points that I was trying to make in one of my previous videos. It's very hard to predict with a huge position what's going to happen incrementally, right? Like dropping from 419 back down to 415, that's very incremental. But getting rejected, for instance, off this trend line, you know, from 450 going all the way down to that 410, 415 level, that's an easier thing to predict. Here now you're dealing in the fringes. So I may short a pop here into this fair value gap. Not entirely sure yet. I will be deciding on that for sure. I'm definitely a nibbler, as I nibbled on the S&P 500 yesterday on the SPY when it was below 410. I did end up picking up some shares of Tesla below 200 here today. Definitely want to keep an eye out on this because I might want to accumulate more and then potentially sell calls against my shares. There is a point at which I will also buy leaps and potentially sell calls against those leaps. That's called a poor man's cover call. And I'm definitely looking at Nvidia here. Here's my thing with Nvidia. It's going to be the last of the Magnificent Seven to report earnings, right? Apple reports on November 2nd. Nvidia reports November 22nd. So whatever happens with Apple, if it's a terrible, terrible earnings report and it's the biggest company in the world, there is a chance that you might be able to play a bearish play on Nvidia with the hopes that it actually breaks below this head and shoulders and fills this gap here. There is a chance for that play, and it could be a sympathy off of Apple since this is the last of the Magnificent Seven. So I will be watching Apple earnings, and if they are terrible, I will likely initiate some sort of short here to cover this gap on Nvidia. Not 100% sure yet, but for sure, if you're in the academy, I will let you know as up to date as possible. And if you want to know, make sure, again, you click the link and sign up below. What else am I looking at? I'm definitely looking at Google here. I think this was a complete overreaction drop. Cloud doesn't even make up 11% of their revenue. And I think that Google dropping, 10% one day and then an additional 3-4% the following days, I do think that there's an opportunity here on Google. So I'm looking at that as well. You can see Amazon actually rallied 11% in 2 days after their drop. So I might pick up Google here as well. And then you guys know that I had a very big GLD position on gold. So I'm just playing the pullbacks on gold, right? Right now you see that there is this bearish Harami candle on GLD. So I'm not going to touch my position, but if we do get a nice retracement into a point of interest, I may long it once again with the hopes of getting back to 190. But this was just an A+ trade. We played gold at around 171, and it's currently trading at around 186. I let half of my position go, but I'm still holding half. So in a nutshell, those are the plays. You guys asked for more of the top stocks, top plays videos, so I will definitely be doing those. But if you got anything out of this, click that thumbs up. Leave it in the comment section below. Let me know what you think the market is going to do. Always interested to hear from you guys. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.